Hello and welcome back to Finspire's Focus on the Markets, second quarter 2020 edition. Good to have you join us again. I'm Chris Karam, Finspire's Chief Investment Officer. This is a quick Markets and Your Money update to our quarter end report published in April. So let's get to it. As always, we're going to share a mixture of facts, figures, and our opinions. So let's start with some good news. We went from a bear market to a bull market in rapid fashion since the quarter end. The S&P has driven approximately 27% higher from its March 23rd lows. The index is down 11.7% year to date as of the market close on May 14th. Being down 12% year to date is a substantial improvement from where we were in late March. From February 19th to March 23rd, the S&P 500 experienced a drawdown of 34%. Although not an unprecedented decline, only a few years since 1980 have we seen such a dramatic change. So which companies and sectors are driving the better recent results? The FANG stocks. The FANG stocks are leading the market recovery. FANG meaning Facebook, Amazon, Apple, Netflix, and Google. As a collective basket, they are near their all-time highs. Earnings reports show the big technology companies simply have been less impacted by the COVID-19 bear market, primarily due to their higher margins relative to the S&P 500 index. The FANG stock's strength, however, is not spread to other asset classes. International equities, which are down 21% year to date, and domestic small caps, down 30% year to date, remain challenged relative to large cap domestic equities measured by the S&P 500. Investment grade fixed income remains as a positive contributor to a diversified, balanced portfolio. Now that we know what has happened since quarter end, we created a thumbs up, thumbs down scorecard on the keys to a sustained recovery. Outbreak mitigation. Have we flattened the curve? What a loaded question that has become depending on your preferred outbreak metric. But we're going to go with a thumbs up for the following reasons. By measure of the number of new daily confirmed COVID-19 cases, the world, the US, and New York have all flattened their curves. No market recovery will be sustainable without gaining control over the virus. Oil price stability is important for a sustained equity recovery because the energy sector is an important contributor to the US economy. We experienced an oil supply and demand shock in March as the virus halted economic activity. We give this metric a thumbs down as oil futures prices recently turned negative. To illustrate this matter, oil producers recently had to eat the costs of delivering oil barrels to consumers as demand plummeted. Recent production cuts and early signals of states reopening allowed oil futures prices to begin their recovery, but we have a long way to go to consider this stabilization and to give it a thumbs up. The Federal Reserve and Congress have continued to inject liquidity and deficit spending into the capital markets. This is a cautious thumbs up. The Fed learned from its credit crisis experience in 2008 and applied their knowledge to quickly add the necessary liquidity to backstop the banking system and the credit markets. Future debates will be had regarding the scale of the Fed's actions and the scale of congressional deficit spending. Those credit markets have benefited from the Federal Reserve's liquidity measures and backstops. Equity market recoveries cannot sustain themselves without stable credit markets. We give this metric both a thumbs up and a thumbs down. Investment grade credit and high yield credit spreads have tightened, which means the Fed's actions have had a positive impact on an initial credit stabilization. The Fed is now discussing buying credit market ETFs to further support its efforts, making higher yielding debt a potentially attractive investment opportunity. It all eventually comes down to the economic and earnings fundamentals when assessing the potential for a long-term equity market recovery. Unfortunately, we must give this metric a big thumbs down. The US economy predictably contracted in the first quarter with a negative 4.8% growth rate. Second quarter estimates are dismal, where we could see negative 25% plus contraction in economic performance. The U3 unemployment rate skyrocketed to nearly 15%, reflecting the tens of millions of unemployment claims declared over the last several weeks. U6 unemployment, which includes underemployed workers who desire to work full-time, also jumped to over 22%. Earnings have been revised sharply lower, with the greatest impact occurring in the energy sector. You can see relative to the big technology stocks performing well, earnings growth expectations in the energy sector have been reduced by 83%. Stability in the oil markets should pave the way for a stabilization in the energy sector over the next 2 to 3 quarters. We will continue to update our keys to success, identify investment opportunities, and recommend you remain patient. We are committed to helping investors through turbulent times by keeping you informed with news you can use, interactive portfolio consultations, and a professional team that stands ready to support your tomorrow. Visit us at finspireme.com to engage with our team or check out our YouTube channel. Thank you, and we'll talk to you again soon.